Hey everyone, and welcome to This Explainer. I am absolutely thrilled to have you here today. Look, if you're a focused learner trying to really wrap your head around how capital flows and more importantly, how it compounds, you are exactly in the right place. Today, we're setting the stage for a really deep dive into one of the most polarizing financial concepts out there, using life insurance to build wealth. It's a strategy that has sparked massive debates online and in financial circles. But by the end of our time together, you're going to understand exactly how proponents of this strategy claim the wealthy actually control their capital. Okay, let's dive into this. Because honestly, we have to address the elephant in the room right out of the gate. Is infinite banking a total scam? Some people swear by it, they literally build their entire financial lives around it, while others, they immediately write it off as a trap. And here is the truth derived directly from our sources. It absolutely can be a trap. If you're just buying a policy from a typical life insurance salesman who only wants a quick payout and has zero intention of actually helping you set it up like a bank, yeah, you're going to get burned. But the sources argue that when it's structured correctly, it transforms into an incredibly effective financial tool. So here is our roadmap for the explainer. We're going to cover the infinite banking concept, how it completely flips life insurance upside down, the asset buying cycle, how to avoid that nasty commission trap, and finally, the tax-free retirement plan.
All right, kicking things off with Section 1, the infinite banking concept. So, what exactly is it? Well, this entire financial movement was actually sparked and popularized by Nelson Nash's foundational book, Becoming Your Own Banker. When real estate investors first discover this concept, it's usually a huge paradigm shift. Basically, infinite banking is defined as setting up an overfunded, high cash value life insurance policy. Now, the absolute core mechanic to understand here is that this isn't about dying. Proponents say it's really about storing your profits in a private mutual company account. When you overfund the policy, all that extra cash sits in a private reservoir, paying you a guaranteed contractual rate of return plus dividends from the mutual company. So the crucial point is this: the single greatest destroyer of wealth over your lifetime is taxes. Period. If you ask the IRS where you can legally put your money to get a tax-free rate of return, the sources point out there are really only three places. First, you have Roth IRAs, but those severely limit how much you can contribute. Then you have municipal bonds, but those rely on local government debt. And finally, you have life insurance. And here's the kicker. As long as you meet the IRS guidelines regarding the ratio of your cash value to your death benefit, there are no contribution limits. The growth in these overfunded policies is entirely tax-free. According to the sources, this makes it the ultimate financial shield. Moving right along to Section 2, flipping traditional life insurance upside down. And this brilliantly illustrates exactly how this strategy restructures the way you think about paying premiums. The goal here is for the policy to actually benefit the living policyholder, you, rather than just your heirs. Think about it. When most people buy insurance, they want to pay the lowest possible premium to get the absolute biggest payout if they die. But to become your own bank, the sources say your approach has to be the exact opposite. You want to buy the least amount of life insurance and pay the most money you possibly can for it. By legally minimizing that death benefit, you can cram as much cash as possible into the policy's tax-free growth engine without violating any IRS rules. When the policy is built right, the sources note that this cash value reservoir of wealth grows at a net return of about 4 to 6%. And that is net, after all the costs of the insurance. Because it's held in a mutual company, it just sits there, completely insulated from the wild volatility of Wall Street, just steadily growing year after year. Which brings us to Section 3, the asset buying cycle. Now, storing cash safely is great, but actually creating wealth, that requires leverage. This is where the strategy introduces a really cool real estate flywheel. The cash value acts as a reliable launchpad for buying cash-flowing properties. Let's walk through this endless recycling loop step by step. First, you overfund the policy. Next, the insurance company opens up a private line of credit for you, allowing you to borrow against your cash value. It's actually their money you're borrowing, typically at an interest rate of around 4.5 to 6.5%, with absolutely no underwriting, no permissions needed, and no questions asked. Third, you take those borrowed funds and use them for a down payment on real estate. And fourth, you use the cash flow from that new asset to repay the insurance company's line of credit. This quote right here captures the absolute aha moment of the entire strategy. Because you're borrowing against your policy rather than withdrawing the money from it, your original dollars never actually stop compounding. That 4 to 6% net growth, it keeps firing on your entire balance while you're simultaneously using the insurance company's money to buy a rental property. Your money is effectively working in two different places at the exact same time. It's wild.
Okay, pay close attention to Section 4, avoiding the commission trap.
Seriously, lean in for this one because the sources really pull back the curtain on the life insurance industry right here. They expose exactly how unsuspecting investors get totally ripped off when trying to set this up with the wrong agent. Let's break down the math on a $100,000 initial premium. You see, life insurance agents make their commissions based on the size of the death benefit. In a bad salesman setup, the agent sells you pure permanent insurance with a massive death benefit. On a $100K premium, they might pocket a whopping $20,000 commission. Crazy, right? But in a proper infinite banking setup, a good agent blends in cheaper term life insurance just to satisfy the IRS minimums. The overall death benefit stays low, meaning the agent's commission drops to a very reasonable $3,000 to $5,000, leaving way more of your money intact to actually grow.
Because of that precise structuring, the materials highlight a very specific benchmark you should look for. 70 to 90% of the money you put in during year one should be immediately available to you as liquid cash value. If it falls short of that, the sources warn it usually means the agent padded the death benefit to feed their own commission check instead of building your personal bank. So to ensure you have total control of this setup process, the sources suggest asking any potential agent two really hard questions. Exactly how much are you getting paid in commission for this? And what is the absolute minimum death benefit I need to satisfy the IRS? Asking these ensures the policy is designed for your cash flow, not their payout. Finally, Section 5, the tax-free retirement plan. Let's move to and see how this builds into the ultimate endgame, projecting forward into a hypothetical retirement where your life insurance reservoir and a real estate portfolio completely merge. According to the sources, doubling your retirement income isn't just about frantically trying to own more and more assets. It's really about the perfect interplay between two things. You need a growth vehicle, which is your real estate appreciating over time, and you need a capital vehicle, which is a life insurance policy loaded up with at least 5 years of your target living expenses in cash value. The real magic happens in how they blend. Let's illustrate this incredible endgame loop. Imagine you want $100,000 a year to live on in retirement. In year one, you take a $100,000 tax-free loan from your policy. Your remaining balance continues to compound entirely uninterrupted. You do this for 5 years straight, while your real estate properties silently appreciate in the background and pay down their mortgages. Then, at the end of year 5, you do a tax-free cash-out refinance on your newly built real estate equity, and you use that lump sum to completely wipe out the policy loan. Boom! You've just created a perpetual tax-free income machine. To summarize the sheer power of this, you're keeping your capital entirely outside of Wall Street. You're creating a private financial ecosystem where, as claimed in the source material, investors running this exact system haven't lost a single dime of their principal in 15 years. You get the stability and continuous compounding of the life insurance, perfectly paired with the massive growth and tax benefits of real estate. It's the best of both worlds. So as we wrap up this explainer, I want to leave you with this thought. Knowing the proponents claim the wealthy use these exact mechanisms to legally bypass taxes, bypass the traditional banking system, and compound their money in 2 places at once, are you ready to look at the traditional rules a little differently? Think about how restructuring your capital, exactly as outlined by these sources, could entirely change a financial future. Thank you so much for learning with me today. And hey, keep asking the right questions.